my name is Abby Robinson, and I'm here to discuss different asset classes.
Today we're going to discuss a few different types of asset classes. This is not a comprehensive list, but a common list of assets that real estate investors target. We'll discuss single-family homes, mobile homes or mobile home parks, and multifamily investments. Number 1, single-family homes. Single-family homes are a great rental investment. These properties offer immediate return and the potential for long-term appreciation, but you should know the pros and cons of the types of single-family rentals before you invest. Single-family homes can be turned into long-term rentals or short-term rentals. Let's discuss the pros and cons of each type of asset. Short-term rental pros. Short-term rentals allow for high potential rents, especially if you live in a seasonal market where people vacation. Typically, you have less wear and tear with short-term rentals because of shorter guest stays, and you have cleaners in and out between bookings who can identify any immediate issues and move quickly to resolve them. There is more flexibility with short-term rentals as well. For instance, you can decide when you want to rent out to guests and for how long. Cons. There are certainly higher upfront costs with short-term rentals, which include furnishings and consumables, among other things. Property management costs are higher, typically between 15 and 25%. Utility costs such as electricity, gas, water, and Wi-Fi are also the responsibility of the owner. Short-term rental restrictions in your market may also have caps on the number of short-term rentals allowed in your area, but can also have strict legislation, so it's worth doing the research ahead of time. Long-term rental pros. Long-term rentals allow for predictable income. This makes it easier to forecast returns. Long-term rentals also allow for easier financing options. You're able to screen your tenants with background checks, income verification, and credit scores. Typically, long-term rentals have lower operating and property management costs, between 8 and 10%. This allows for less time management from the owner. Long-term rental cons. There are lower rents with long-term renting and a possible cap when it comes to raising rents, as it will be difficult to go above average market rents in your area. Maintenance difficulties are more limited, as most of the time you're only ever able to update or maintain the home when the tenant vacates the property. This can lead to larger repairs and maintenance all at once versus maintaining the property over time. Number 2, mobile home units or parks. Pros. There will always be a demand for affordable housing, making mobile homes desirable for low-income tenants. Tenant-owned homes have little to no maintenance, which allows for high cash flow to the owner. Additionally, tenants who own their mobile homes have a harder time leaving the lot due to high moving costs, allowing for more stable lot income predictions. Cons. Mobile homes and mobile home parks are harder to finance with banks, especially when mobile homes are not detitled to the land. Mobile home units depreciate faster, making an exit strategy more difficult. Sometimes it's more difficult to collect rent from low-income tenants as well. Property managers can also be harder to find when it comes to mobile home units and parks. Number 3, multifamily properties up to 4 units. Pros. Multifamily properties are easier to finance, especially when compared to the multifamily class of mobile home parks. Multifamily properties allow for the owner to house hack by living in one unit and renting out the remaining units so that the tenants pay the owner's mortgage and the owner builds equity while maintaining or rehabbing the property. Multifamily investment properties are relatively easy to insure and allow the owner to take advantage of attractive tax benefits. Some cons of multifamily properties up to 4 units include the difficulty finding the right property manager. Additionally, costs can be 2 to 4 times higher than single-family homes when it comes to purchase and rehab, and the rehab typically takes much longer, tying capital up for longer and increasing carrying costs. Finally, due to multifamily property popularity, less availability of these types of assets creates increased competition for these properties. This makes it tough to move quickly on these properties due to the increased analysis required to determine if it's a good deal. Number 4, multifamily properties over 4 units. Pros. Maintenance and rehab are typically lower in cost per unit due to economies of scale when working on multiple units. Costs such as vacancies and repair and maintenance can be spread across many more units, allowing higher and more consistent income. Larger projects allow for higher tax benefits in general, and large multifamily properties are attractive to private money investors, allowing for syndication opportunities. Supplemental income opportunities such as premier parking spaces, laundromat, and garbage pickup are some of the few options available to investors, which can be added to larger multifamily properties. Cons. Most large multifamily properties come with a high price tag, both with purchase price and rehab costs. With more units comes more maintenance, meaning higher management costs. Some investors like to have an on-site manager who lives there. Others veer away from this strategy. Another con is that the asset takes longer to sell due to a smaller buyer pool upon exit because of the higher sales prices. This can potentially make the asset seem less liquid, as it won't sell as quickly as perhaps a single-family home. Because these rehab projects tend to take longer in time and capital, it may be tough to pivot to local market conditions that change quickly. Finally, it can be tough to find private money lending, especially when working under a tight closing deadline. That's all for this week's episode. Have fun investing in different asset classes.